Hey there fellow traders, welcome back to LAGFX. I'm Luke, and in today's video we are going to be unveiling the mysteries of hidden order blocks and take a closer look at the open and closes of candles within the Forex markets. Again, we are presented with a wick to the downside followed by a wick to the upside. So what we are interested in is finding some kind of order block on the lower time frames. So if we just go down, again I'm just going to press the replay button, and if we go down on the lower time frames, what are we presented with? A clear order block that's been left over in the markets and that last buy to sell region. Now, before we jump into today's video, if you are passionate about trading strategies and unlocking the secrets of the Forex markets, make sure you hit that subscribe button and ring the notification bell. This way you guys will never miss out on our latest insights. Now, let's not waste any time. Hidden order blocks, have you ever heard of them? We will break down what they are, why they matter, and how you can leverage this knowledge to enhance your trading game. And that's not all. Stick around as we analyze the significance of the open and closes of the Forex candles. Understanding these can be a game changer in predicting the market's price movements. So if you guys are ready to level up your trading skills, grab your coffee, hit that like button, and join me on this journey through hidden order blocks and candlestick magic. Okay, so to start off, what I've done is I've actually drawn out an hour chart as well as a 30-minute chart. Now, this is just something that I've created, and this isn't going to be exact as to what we see in the actual live markets, but it's a very, very good example. And the reason why I'm showing you this is because what I want to highlight is the actual characteristics that we need to be looking out for when we come to find these hidden order blocks. Okay, now the reason why this ties in very well to opens and closes of candles is because by understanding the open and close of candles, we are able to understand what is happening inside of those wicks. So you can see here on the left hand side we have an hour time frame of a bullish market, and what we are presented with is a wick to the upside followed by a wick to the downside. Now, what this tells us in terms of price action and what price is actually doing is when this candle opened, price was here. Okay, price has traveled up throughout this hour and it's traded as high as this point. Now, when this candle closed, it actually closed down here. So before the candle closed, price had to travel from here down to this point. So that tells us that there is bearishness inside of this wick. Now, when this candle has closed and this new candle has opened, i.e. here, what we have seen is we have seen a continuation in bearishness. Why? Because we have a wick to the downside. So this tells us that price continued in a bearish way, trading lower, before actually trading higher and closing up here. So therefore, we had a continuation in that bearishness that we began to see in the previous hour candle. So obviously you can see on screen I've highlighted a red line, and I've drawn a red line from this wick to this wick, and that is basically just displaying that that's bearishness inside of that area in price. Now, when we look to the 30-minute time frames, you can see those candles that have actually been created. So what we are seeing is price trade up, price then trading down, and then we have a large high volume candle to the upside, as you can see here. That's continued trading us higher. Now, what you'll notice is price never comes back down to trade into this area. So this is our order block. This is our unmitigated area that has been left over and needs to be cleared before trading higher realistically. So this gives us a point of interest. If we're looking to go long in a bullish market, then we should be looking for areas like this, last sell to buy regions, as these are order blocks or footprints that have been left over by institutions. Now, not every time are we going to see a wick to the upside followed by a wick to the downside, but that is a key characteristic that we should be looking out for. What we may see is a wick to the upside, but no wick to the downside. But this still tells us that there was some bearishness present within this market on the lower time frames, because price did trade up to this point, but ended up trading lower and closing down here. So we still have that bearishness from this 1 hour candle here. As you can see, this is the example that we've got on the 30-minute time frames. And the same applies. This is an unmitigated area that needs to be mitigated before price can trade or continue to trade in a bullish way, giving us a refined area in price that we can look to capitalize in bullish positions from. Now, one of the main things I want you guys to take away from this example here is when we are looking for hidden order blocks in a bullish market, look for a wick to the upside followed by a wick to the downside, because that tells us that bearishness is present on the lower time frames. So this is the characteristic that you should be looking for when looking for hidden order blocks within a bullish market. Okay, so now moving over to a bearish example, everything is the exact same apart from it's just reversed. So as you can see with this bearish impulsive wave on the 1 hour time frames, rather than it being a wick to the upside followed by a wick to the downside, it's now flipped. So what we look to see is a wick to the downside followed by a wick to the upside. Now why? Because price would have had to trade down as low as this point within this 1 hour candle, but what happened is bullishness was introduced, which traded price higher, and price ended up closing here. Now when this candle opened, we had a continuation in bullishness as a wick was formed to the upside before price then traded lower, closing here. So we understand that from this wick to this wick, there was bullishness present on the lower time frames. So with the bullish example, you can see that it was wick to the upside followed by wick to the downside, whereas with this bearish example, it's wick to the downside followed by wick to the upside. So that is the main characteristic that you need to be looking for when looking to go short in a bearish market, and you're trying to distinguish and find these hidden order blocks. Now again, there are going to be times where we don't have the wick to the downside first, and we are just delivered with the wick to the upside. But we understand now, by understanding the open and closes of candles, that when this candle closed, this candle opened, but we had bullishness before price then traded lower and closed down here. So therefore, inside of this wick is bullish structure. Now, when we have high volume to the downside that follows after a wick, we understand that there is a possible chance that that area in price is unmitigated, and it is something we should be looking at. So that is just a quick example for hidden order blocks on a bullish market and hidden order blocks on a bearish market. What I'm going to do is I'm going to go over to the live markets, and I'm actually going to show you these examples and how they've played out in real time. Not only am I going to show you the hidden order blocks, but then what we're going to do is we're actually going to digest that information. We're going to go down on lower time frames, and I'm actually going to highlight and distinguish the actual order block that presents itself to us on the lower time frames. Now then, to add to my analysis and to add to my point and knowledge that I'm trying to share with you guys, what we're going to see is how price reacts perfectly to these zones and areas. Okay, so what I've done is I have marked out just a few examples. Now, just something that I need to point out, not every time are these areas going to be respected. This is the same with order blocks themselves. Not every time are they going to be respected. Sometimes we are going to see price trade through them, and that is just based on that supply and demand balance. Sometimes there isn't enough supply or demand in these areas or in these order blocks for us to see that reversal. But it doesn't mean that these aren't areas of interest. So you can see the first example we have here. We have a bullish trend trading us higher. Price trades up to this point before reversing to the downside. Now, when we draw our line and go across, you can see that we are presented with the example that I gave earlier, a wick to the downside followed by a wick to the upside on a bearish market. Now this is great, as this tells us that there is bullishness present on the lower time frames. Why? Because in order for price to trade from here to here, there must have been some kind of bullish structure. So we just get our replay button and we go back to this area in price. You can see that as we go down on the time frames, those bullish candles begin to present themselves to us. These aren't visible on the time frame that we were looking at originally, which was the daily time frame, but as we go down on time frames, this area starts to present this bullish structure. Now you'll notice that we have wicks to the upside here. Again, this is great. This is another thing that we should be looking at when we are looking for areas of supply in a bearish market, because in order for order blocks to be created, and in order for us to see last buy to sell regions, a lot of the time we will see wicks to the upside because price will have had to trade it up in a bullish way, but price has actually closed down back at this point in order to create that wick. Now, as we continue to go down on the time frames, you can see that the order block begins to present itself to us. So now, as we've gone down and down and down on the time frames, the area that we are really wanting to focus on begins to present itself to us. Now, unfortunately, because we are back in 2021, I can't actually go down to as low as the 5 and 15 minute time frames to actually show you the order block, but best believe it was there. Now, if we go to another example, but in more present time, we should be able to go down in those time frames to actually see what's going on. So you can see again here, we are presented with that wick to the downside followed by the wick to the upside. We have price trade up to clear this area of supply before continuing to trade us lower. So if we just get our replay button again and we change it to this. Now, as we go down on time frames, what I'm going to do is I'm just going to highlight this area out. So this is the area that we are looking at. As you go down on the 4-hour time frames, you can see that the last buy to sell region presents itself to us clearly. This has clearly been left unmitigated. Price has not come to trade up and into this. As we press play, price trades up and into this area in price before delivering us with a new bearish leg. So this is a clear example that can be seen on the 4-hour time frames, luckily enough. Now moving to our third example, you can see again we have bullish structure coming back up to clear this area of interest, to clear this hidden order block. Again, we are presented with a wick to the downside followed by a wick to the upside. So what we are interested in is finding some kind of order block on the lower time frames. So if we just go down, again, I'm just going to press the replay button. And if we go down on the lower time frames, what are we presented with? A clear order block that's been left over in the markets and that last buy to sell region with plenty of inefficient structure laying below. Now, what makes these areas stand out more than anything else is the fact that there is always going to be inefficient structure below when we are looking at last buy to sell regions, and there is always going to be inefficient structure above when we are looking at last sell to buy regions. That is obviously for our bullish entries, and that is something that we'll be looking at in just a moment. Now, the reason why it's important that we do see inefficient structure above and below these areas of interest is because what that tells us is that the institutions were in control of the markets at that moment in time. And therefore, there must be, or there should be, an area of interest or a footprint that has been left behind for them to take advantage of. So we should always do our due diligence and we should always do our analysis carefully and cautiously to try and find areas that we can also manipulate and take advantage of. So again, moving to another example, you can see here that we do have a wick to the downside followed by a wick to the upside. The wick to the downside just isn't as large, and this will happen. Sometimes they'll be really long, sometimes they'll be really short, but what we are still looking for is that downside wick to the upside wick. So we can see that there must have been some kind of bullishness present within this on the lower time frames. Price has come to trade up and into that, cleared that area of interest before creating that next bearish leg. Now when we go down on the time frame, so I'm just going to press the replay button again. When we go down on the time frames looking at the 4-hour, you can see how this area is clearly presented to us. Now this is no fluke that price is doing this when I'm looking at these areas in price. It is just about understanding the open and close of candles and understanding that these areas in price do exist and why it is important that we should be looking for them. Now you can see here again, we are delivered with that same pattern, downside to the upside. So what we could actually do is if I just move this to the left and we draw a new line like so. If we go down to the 1-hour time frames, so it doesn't present itself there, which is fine. If we go down to the 30-minute time frames, you can see that that order block clearly presents itself to us. Has it been left unmitigated? Yes, because price never came to trade into that candle. And if we can just prove this by drawing a box around it, you can see that price never traded up to actually clear this area in price. So it was left unmitigated. Now when we drag this across, we get rid of the initial line that we drew, you can see that over time, we may have to speed this up, so just bear with me. you can see how price has clearly traded into this zone, cleared this candle that was left unmitigated, that we were able to distinguish and find on the extreme higher time frames without having to go down to the 30 minutes. And we would have been able to take advantage of a brilliant short position. Now, in terms of the trades that I place and how I go about setting my stop loss and take profit, I'm just going to show you a quick example of some of the profits we would have walked away with. So our entry would have been within the zone. Our stop loss would have been placed just above the zone. I always give myself 2 pips worth of leverage just in case spreads decide to try and take us out. And what I would have done is I would have placed my take profit just above the previous swing low. Why? Because we understand that this is a bearish market, and in bearish markets we are delivered with lower highs and lower lows. So I understand that every low is broken to create a new lower low. So this low here should be broken to create a new lower low. Now, by setting our take profit there, it guarantees that it's more than achievable. And as you can see, our take profit would have been achieved. We would have walked away with a brilliant 1 to 13 risk to reward ratio. So if you're risking 1% of your equity, you're looking at 13% gains from this position. If you risk 2%, you're looking at 26% returns from this position. So this is just a key example of these hidden order blocks. The reason why they are genuinely so important is because you are able to find hidden order blocks that may be present on the 1, 5, 15 minutes, on the 1 hour, 4 hour and daily time frames. So just by understanding why price is creating these wicks to the upside and the wicks to the downside, you are able to completely take advantage of the markets and have a greater understanding on the why and why price is doing the things it's doing. Okay, so I think that's enough for the bearish examples. What I'm going to do now is show you some bullish examples. So now what we are looking for is a wick to the upside followed by a wick to the downside. Again, this tells us that there's bearishness present. And just to kind of help you guys remember how it should look, you can always just draw a line from one wick to the other, and it should, if we are looking to buy into a market, the line should be going down. If we are looking to sell into a market, the line should be going up. A line going up means bullishness is present. A line going down means that bearishness is present, and that's what we should be looking for. Okay, so in this example, again, we see price trading down, correcting itself before its next impulsive wave. Price trades down and into this area of demand, this hidden order block. We can see that we are delivered with the up wick to the down wick. If we just go down to the lower time frames, we are going back now to 2020, so probably won't be able to go down too low of a time frame, but hopefully, yep, we can see that we are delivered with some bearish structure. Now, hopefully we can go down to the 1 hours. Perfect. And as you can see here, the order block presents itself perfectly to us. So we just get rid of this line, we get rid of this. You can see that the order block that we were looking at trading down and into is actually presented itself to us like so. So we have that bearishness inside of this area in price. Price comes to trade down perfectly into this before a continuation in bullish structure. So that is our first bullish example. Okay, now just heading to our second example, you can see here price has traded down, putting in that correction before the next impulse. And you can see here that price has again traded into an area that presents us with that wick to the upside, followed by a small wick to the downside. Now, the wick doesn't actually show itself very much, and that's absolutely fine. As I said earlier on at the start of the video, not always are we going to see that wick to the downside, but what we do need to see in these bullish examples is that there is a wick to the upside. Why? Because it tells us that price once traded up to create this high, but actually came down to close here, which means that there must be some kind of bearishness inside of this wick. So if we just press the replay button again, and let's head to the 4 hour time frames. Perfect. So you can see here that actually we don't even need to go down any lower on time frames. The order block itself is clearly displayed for us on this time frame. What price did is price traded into this order block, rejected nicely to the upside, and gave us that next impulsive wave. So here is another example, perfectly done. Okay, cool. So I'm going to show one more bullish example. And then we are going to finish this video off just by going over some other things that I want you guys to take into consideration when analyzing the markets. Some important factors that you should take away with you when it comes to analyzing these markets in the future. Okay, so you can see price traded down to create this low, and we saw rejection to the upside. Yes, we are within a bearish trend. However, price did still deliver us with bullishness and did trade and react well to this hidden order block. So if we just go here to the left, you can see that we are again delivered with that wick to the upside followed by the wick to the downside. We just get our replay button. This is the area here. We just go to the 4 hours. You can see how price clearly has given us that last sell to buy region. Again, this has been unmitigated. Why? Because price created that inefficient structure and never traded back into this area to clear that area of liquidity. Okay, so that's enough of those examples. I just wanted to highlight a few areas and a few zones just to display that this genuinely does work, and these are genuine areas that have been left unmitigated on the lower time frames. Now, whenever I state anything about the Forex markets and I share knowledge with you guys, I find it very important to actually show examples. So that's why we did that. What I'm going to do now is just finish off this video by having a quick conversation and explaining the true importance of understanding why the candles are doing the things that they are doing. Okay, so when we look at a bearish market, we understand that we obviously want to get involved in short positions. So when a market is trading us lower, we don't want to be looking to buy into this market because we are ultimately trading against the majority traders. Now, the key points to get involved in this market are always going to be at the peaks, okay? Now, on the opposite, when a market is trading us in a bullish way, we don't want to be selling into this market. We want to be buying into this market. So we are trading with the prevailing trend and we are trading alongside the majority traders. Now, we don't trade from the peaks in this instance. We trade from the troughs. So we want to trade from the lows that are created. Now, in order to find those lows, what we need to be doing is we need to be looking at the previous impulsive waves to find any areas of demand that have been left unmitigated, which are some of the examples that we went over today. And the same with a bearish market. We want to be trading from these peaks, but we need to find out where these peaks are going to be created. So to find where these peaks are going to be created, we need to look at the previous impulsive wave that traded price lower to find areas that have been left unmitigated. Every impulsive wave is always longer and larger and deeper than any correction. When we start to see that volume slow and we start to see those impulsive waves get shorter and shorter and shorter, like this, that tells us that we are slowly introducing more buy positions in this example here to reverse the market fully to start trading in a new direction. So we are offloading any shorts that we are adding to the markets and we are introducing more buys. This flips that supply and demand balance. Now, the reason why I'm explaining this is because people fail to understand the reasoning why the markets do the things that they do and why it's so important to understand market structure and why it's so important to understand price action. If you are unsure about price action, market structure, protected highs and lows, I would honestly take the time to watch some of our YouTube videos as we go over these things in great detail. James has recently put a video out, As I Learn to Trade, which goes through some brilliant examples, and he has a brilliant way of explaining these things in great detail. Okay, so to finish off this video, I just want to briefly touch on the importance of those wicks to the upside and the wicks to the downside. Okay, so when we are looking at a bearish market, we understand that price will deliver us with a continuation of bearish candles, right? This is a rubbish drawing, so ignore my rubbish drawing. But what we need to pay attention of when we look at these bearish candles is if there is any wicks to the upside like this. Because if there is, what does that tell us? Well, that tells us that price actually, when it opened here, so it closed from this candle and it opened here, okay? When it opened, there was actually bullishness that traded price up, but then price actually traded lower to close down here, okay? So that means that there must be bullishness present inside of this wick. So this could be an area of interest, and this could be a last buy to sell region when trading in a bearish market. What are last buy to sell regions? This right here is a last buy to sell region. This here is a last buy to sell region. Why are they important? Because when price trades up and into these areas of interest, we should see price reverse from them, as we understand that there are buy orders waiting to be cleared and for more sells to be introduced in order to continue trading that price down in a bearish way. Now the opposite applies when we look at a bullish market. So what we should be looking for are wicks to the downside. Why? Because if we have candles like this and we are delivered with a wick to the downside, that tells us that when this candle closed here and this candle opened here, there must have been bearishness present on the lower time frames to create this wick. But then price obviously shot up and traded to this point and closed here. So inside of this wick will be sell orders that could need mitigating. So it's always important to just go down on the lower time frames just to double check those areas in price. Now again, it's only fair that I show real examples on the live markets. So as you can see here, we saw that price traded down, created these lows, right? And evidently it's traded into something. We just can't see it on this time frame before continuing to trade higher to create that new impulsive wave. Well, if we just highlight this area, you'll notice that what we are highlighting is a wick to the downside within a bullish impulsive wave. So going back to my point earlier, it's very important to look for those wicks to the downside in bullish markets and in bullish trends, just because inside of this could be an unmitigated area. Now, if we press the replay button, we go down to the 4-hour time frames, you can see that price is starting to create that bearishness and it's starting to present potential areas that have been left unmitigated. Again, we are starting to divulge and see more. Now, as we go down to the 30 minutes, we are now presented with that wick to the upside followed by that wick to the downside. So this is why it is always important that we take notice of the open and closes of candles, wicks to the upside in a bearish market and wicks to the downside in a bullish market, because inside of those could be areas of interest. Now, I'm not telling you to look at every single wick to the downside because you'd be there all day, but just keep it in mind when you're looking to enter in on a bullish market and entering in on a bearish market as well. Now, just to finish this video off, I mean, just by looking here, you can see how price came to trade down, and it came to trade into an area that gave us a wick to the upside followed by a wick to the downside within a bullish market, which is what we want to see. And you can see that price did it again here, traded into an area that presented us with a wick to the downside. It didn't present us with a wick to the upside initially, but it did give us that wick to the downside before trading higher after a high volume candle. So again, that's just another 2 examples that I can see just here. Again, another example, we have wicks to the downside, price came to trade into those perfectly, so inside of that could be an order block, and we see this happen over and over and over again. People just don't understand and haven't actually paid attention to knowing why price trades into these areas. Again, price came to trade down here. What did it do? It traded perfectly into this wick to the upside followed by a wick to the downside. Again, it's another hidden order block on the lower time frames. And as I say, this happens all of the time. So what I would advise you guys do is head over to TradingView or MT4, MT5, whatever software it is that you use to analyze the markets, and just complete this exercise. Go on to any time frame, whether it's the daily, weekly, 4-hour, and have a look at the lows that are created. Draw a line from where the low starts and drag it back to see what it's traded into. And if price is traded into something like this, or with the bearish markets, it's traded into a wick to the downside followed by a wick to the upside, replay time, go down on the lower time frames and see what it's actually traded into. 9 times out of 10, there will be an order block presented to you on the lower time frames. So just to round up this video, this is a brilliant exercise and a brilliant way of finding those order blocks on the higher time frames. I can almost guarantee there has been times where you have gone to place a position in the market and price has just gone off without you, and it's because it's traded into a hidden order block that you've missed. Now, this should alleviate a lot of that. I'm not going to say that you're going to catch every single trade and you're going to catch every single swing, but what this should do is it should eliminate a lot of those trades that you may have been missing in the past. Now, I hope this video has helped you guys and you have actually learned something from this. If you have done, please leave it a thumbs up. All the support you guys provide is very much appreciated. And if you want me to go into greater detail on this, then I will do. Just leave it down in the comments below if you're still struggling to understand the concept and what it is that we are actually looking for. And if you have any other ideas on videos, or if you're unsure about anything in the markets, leave the suggestions in the comments below and I'll be sure to create a video based on that. Now, if you stumbled across this video just by chance, then today is your lucky day, because there aren't many people out there that either know about this or they don't share this kind of information. And the reason why is because it is such a game changer. So if you do want more tips and tricks when it comes to the Forex markets, don't forget to subscribe to the YouTube channel and go ahead and join our Learning Lounge group chat. The link will be in the description. Now, I just want to say a massive thank you for watching, and we'll catch you all in the next Learn to Trade video.